Welcome back to the deep dive. So if you're an early stage founder, you probably know this feeling. You're running at a million miles an hour, and the only number that really truly matters is the cash in the bank, right?
Yeah, it's always the case.
But then you talk to an accountant or you even think about raising money, and suddenly they're demanding these statements based on GAAP or IFRS. It's this massive tension.
It really is.
Okay, so let's unpack that. On one hand, you need something simple, something that just tracks cash in, cash out, so you know if you can make payroll.
Right.
But on the other, you've got the IRS or the CRA in Canada, and definitely investors, demanding these formal reports, the kind that show accrual accounting.
And that is probably the single greatest point of friction for a scaling business. But here's the thing, the strategic secret, if you will.
A secret, I like that.
It's that you don't have to start with all that complexity. The solution isn't some new fancy fintech app. It's actually a strategy that good small business accountants have been using for decades. We call it the adjusted cash basis.
The adjusted cash basis. It sounds like you can have your cake and eat it too.
That's exactly what it is. It's the best of both worlds. You keep your day-to-day simple, understandable, for 11 months of the year.
And then
You pay an expert to come in once, just for compliance, to make those complex tweaks.
So that's our mission for this deep dive, to really understand this hybrid system and why it's so powerful for U.S. startups in particular.
Especially in the U.S., yeah. The tax rules there are a game changer.
And how you can use this old school wisdom to save yourself time and, let's be honest, a lot of money. Let's figure out how to keep your investors happy without driving yourself crazy. Okay, so to really get why this hybrid is so smart, we have to define the two sides of the coin. Let's start with the one every business owner just gets.
Right. We start with cash basis accounting. And it's the simplest way to think because it's just a direct mirror of what's happening in your bank account.
Money in, you count it. Money out, you count it.
That's it. The rules are, they're almost intuitive. Revenue gets recorded when the cash actually hits your account. And expense gets recorded when the money actually leaves.
It sounds wonderfully simple. I mean, that's how I manage my own finances at home.
Precisely. And for a startup, that has a huge practical advantage because all the data is generated naturally by your bank and your credit card statements.
So it's easy to track.
Super easy and very reliable. It answers the most important question for any founder. Do I have enough cash to pay my bills next week?
So if it's that easy, why? Why did we invent something else? I mean, why does GAAP, generally accepted accounting principles, make life so hard? Is it just accountants trying to justify their jobs?
Haha, well, it can feel that way. But no, there's a good reason. The problem with the cash basis is it can be really misleading about how your business is actually performing.
Oh, so?
Imagine you land a huge client in December. You do all the work.
Yeah.
But they don't actually pay you until February. On a cash basis, your December looks awful. No revenue. But economically, you had a fantastic month. You earned that money.
Okay, I see the conflict. And that brings us to the other side, accrual-basis accounting.
Exactly. Accrual is what GAAP and IFRS require for any kind of external reporting investors, banks, you name it. Because accrual tries to capture the economic reality of a period. So revenue is recorded the moment it's earned, whether you've been paid or not.
And expenses.
Same idea. Expenses are recorded when they're incurred, even if you haven't paid the bill yet. It gives a much clearer picture of your actual profitability, but
it sounds like a nightmare for day-to-day bookkeeping.
it can be. You're tracking promises and obligations, not just cash.
Okay, this is where it gets really interesting for me. The moment of magic. How do you take that simple, clean cash data from the whole year and turn it into the complex, compliant accrual statement that everyone demands?
This is a skill. This is what you pay a good public accountant for. It's called the year-end adjustment process, or more technically, cutoff procedures.
Cut-off procedure.
Right. Because you, the founder, have been running on that simple cash basis all year, the accountant just steps in once, right around your fiscal year end, say December 31st,
Yeah.
and makes a few very specific surgical entries.
So they're not redoing all of your books.
Oh, God, no. They're only looking at the transactions that straddle that year-end date. And they really just zero in on 4 main accounts where cash and accrual are different.
Okay, let's walk through those, but, slowly for the non-accountants listening.
Absolutely. The first one is accounts receivable, AR.
AR, so the money that people owe you.
That's it. Let's say you did the work and sent an invoice on December 20th. You earn that money in December. But the client's wire transfer doesn't land until January 5th.
So on a cash basis, that revenue shows up in the new year.
Correct. So the accountant's job is to create one adjusting entry that, pulls that revenue back into December. It makes sure your December report shows that you earned it then.
Okay, that makes sense. Earned, but not yet received. So what's the opposite?
That would be accounts payable. AP. This is the money you owe to others, right? So maybe you got a big bill from a supplier in December. You use their services in December. But you decide, for cash flow reasons, to pay that bill on January 2nd.
My cash looks better in December, but I definitely incurred that expense in the old year.
Precisely. So the accountant has to adjust for that. They have to record that expense in December, otherwise your December profits are going to look artificially high.
Makes perfect sense. Okay, what about if you sell, like, actual physical stuff?
That's number 3, inventory. If you sell products, the accountant has to make sure that the value of all the stuff sitting on your shelves on that cutoff date is correct.
Why is that?
Because you can't expense the cost of that inventory until you've actually sold it. Your cash system might show you spent $10,000 on inventory in October, but if it's still in your warehouse on December 31st, it's an asset, not an expense.
Oh, okay. And the last one, this feels like the trickiest one.
It can be. It's all about timing mismatches. We call it prepaid expenses and unearned revenue. Let's take prepaid expenses. In December, you pay $12,000 for your business insurance for all of next year.
Right.
On a cash basis, that's a huge $12,000 expense in December. Kills your profit for the month.
Yeah, ouch.
But under accrual, you've only used 1 month of that insurance. So the accountant creates an entry that treats $11,000 as an asset, a prepaid asset, and only $1,000 hits your December income statement. They spread the cost out.
So that one surgical adjustment done once a year is the key.
It's the entire key. It aligns your simple internal books with the complex reality that investors and tax authorities want to see without you having to live in that complexity every single day.
So if this is such a brilliant strategy, what does it mean for, the scary part, tax compliance?
Yeah.
Because that's what really forces people's hands.
It is, and this is where the difference between operating in the U.S. and, say, Canada is it's night and day. For U.S.-based startups, the strategic advantage is enormous. The IRS basically gives you a free pass on this. For most small businesses, filing a Schedule C or a corporate form 1120S, you are allowed to use the simple cash method for your taxes.
Really? Just allowed?
Yes, it's driven by what's called the IRS Small Business Exemption. The rule is basically, if your average annual gross receipts for the last 3 years are under an inflation-adjusted number, for 2024, it's about $30 million, you can use the cash basis.
Wait, 30, as in 30 million.
It's $30 million, yeah.
So that means virtually every single startup for its first, 5-7 years of life, they all qualify.
Almost all of them, yes. It is an incredible gift of simplicity from the tax authorities. You can run your books on a simple cash basis for tax, and you only need those cutoff adjustments if you're preparing GAAP statements for, say, an investor.
Wow. Okay, so now tell me about Canada. I'm guessing it's not so generous.
Not even close. It's a completely different world. In Canada, the Income Tax Act pretty much requires the accrual method for almost every business.
No exceptions.
Well, there are 3 very, very narrow exceptions. You can use the cash basis for income tax if you are a farmer, a fisher, or a self-employed commission agent. That's it.
So you basically have to be working outside or selling things for other people to get the same simplicity that a $29 million U.S. tech company gets automatically.
That is the stark contrast, yes. Now, there are some other modified rules for professionals, but the big takeaway is this. Canadian businesses are forced into accrual complexity much, much earlier. The U.S. system lets you focus on simplicity until you're pretty darn big.
Okay, so clearly this hybrid system is the way to go for a U.S. startup. But let me just push back for a second here.
Go for it.
If I know I'm going to raise venture capital and I know they're eventually going to demand GAAP statements,
Yeah.
why not just start with GAAP from day one? Rip the Band-Aid off early.
It's a fair question, and it sounds logical on the surface. But it completely ignores 2 critical things, cost and quality. The whole point of the adjusted cash basis is cost efficiency. Running a proper, complex GAAP system 365 days a year is wildly more expensive than managing a simple cash system. You're trading 11 months of high-cost bookkeeping for one short period of high-value adjustment work. And honestly, unless you're about to do a Series B or go public, full-blown GAAP is probably overkill. Most smart early-stage investors actually prefer clean, auditable cash flow data.
And you mentioned quality. What's the strategic warning about rushing into this?
This is the real danger, a poorly implemented GAAP system, which is what usually happens when a startup tries to do it too early, costs a fortune to fix later.
Right.
But even worse, the numbers it produces are often just garbage. They can create these overly optimistic historical profits that look great on the surface, but any sophisticated investor doing their diligence will spot it a mile away and run.
So bad GAAP is worse than no GAAP.
So much worse. It's way safer to stick with clean, consistent cash data until you have the resources to do GAAP right.
So how does this implementation model work in the real world? How does technology help founders do this?
This is where things get really efficient now. The sources we looked at point to this model. You use technologies, like some developed at the hatchery, that streamline and standardize that simple cash basis process.
Right.
This lets a U.S. founder leverage, say, highly skilled but cost-effective remote accounting technicians in places like the Philippines. They can maintain that super clean, bank statement-driven system all year round.
So you get the global cost benefit, but on a simple, manageable system.
Exactly. The result is a rock-solid, fully compliant cash basis system. Then, come tax time, a U.S. tax professional can do those year-end accrual adjustments quickly and cheaply. And that makes the eventual switch to full U.S. GAAP painless because your foundation is perfect.
And this is a better model than some of the other things founders are being sold.
A much better model. What we often see fail is founders using generic, venture-backed finance-as-a-service companies, especially those trying to manage U.S. compliance from, say, India, without deep, specific U.S. GAAP expertise.
And what happens?
They try to force a complex accrual system on a tiny company. It creates this incomprehensible mess that doesn't work for U.S. GAAP, doesn't work for IFRS, and often doesn't even work for the tax department. You think you're saving money, but you end up spending 10 times more just to clean up the mess later.
Okay, so let's boil this all down for the founder who's just tired. Tired of chasing invoices and worrying about complex reports. The path to being investor-ready doesn't have to start with extensive, premature complexity.
Not at all.
It sounds like the smartest, most cost-effective path is this combination. Simplicity on the inside, running on a cash basis, plus that periodic expert intervention at year-end, especially with the flexibility the IRS gives you.
That's it, precisely. And that leads me to, I guess, a final provocative thought to leave you with.
Let's hear it.
Given that this simplicity is so key until you're raising really big institutional money, how should that change how you evaluate your potential investors? Should you maybe start actively looking for the investors who get this? The ones who value clear operational cash management over someone who prematurely demands a complex, expensive GAAP report they probably don't even need yet.
That's a powerful position to be in, knowing that.
It is. Understanding this isn't just about accounting. It's about giving you power and leverage in those investor negotiations. You should use it.